Ladies and gentlemen, it has come that time in which we will have our November edition of the strategy meeting. If you're new to the briefing service, this is where we bring our trading team together and we have a roundtable discussion and talk about some of the themes that we may be seeing. I'm going to welcome all the gentlemen in. I'm going to start with Brett Manning, and you know him as Chart Trader. So, welcome in. Brett, how are you?
I'm doing pretty good, Jim. How are you?
I'm doing quite well. We have had a collective, tumultuous market over the last couple of weeks. And of course, we've seen earnings season, we've had the election, we've had a tussle over the results of the election, and I think it's safe to say that we at least have somewhat of a direction as far as where we're going politically. And so, with that said, I think, Brett, that we are kind of under a market reset. As we head into the end of the year, we do have some things settled, but what do we do now? Where are we going? And I don't just mean with the market, I mean just as far as money flows in general. So, you have the floor, my man.
Yeah, so really quickly, just to kind of establish our analytic position on the situation, as far as we understand things, certainly myself, and I think that we've talked about this before, the election is over. And I'm sure you've heard Carmine saying the same thing, and I would say that there's a reasonable case to be made that the election fraud challenge is a version of political theater that will probably be very effective in maintaining Trump's power position in Washington, D.C. past this point, and that's a fact that's germane to analysis. To give you an example, if somebody were to stand up right now who's in the House of Representatives on the GOP side and be very public about addressing President-elect Biden, I mean, I would imagine he can assume that he will be facing or she will be facing a Trump-supported primary challenge in 2 years. And that is power. That is a consolidated base of power, and this process that we're seeing right now is probably going to be really important for the types of policies that we can see because it's enough power. That base is big enough that he can wield that it's going to impact how things work in Washington, D.C. I don't want to get too in the weeds on that, but I think that there's a reason why this is happening, and it's not because the results of the election can be overturned. So far, basically, if Trump were to win pretty much every single one of the lawsuits, it really wouldn't even change the outcome of the election. So that's how we can take this position. And basically, all of these are being thrown out without even being heard because there's not enough evidence to proceed in the courts. So that's where it stands. That's a verifiable fact at this point. So the election is over. Biden's going to be president. Trump's still going to have a tremendous amount of power. And we don't know where the Senate's going to end up, and that's important as well. And the Georgia runoff is on January 5th, and it is probably a significant factor that turnout in favor of the two Republicans who are the incumbents could be limited a little bit by the fact that people aren't going to vote for or against Donald Trump. So not having Trump at the top of the ballot, which was the case on November 3rd, had we not had this runoff, they had Trump at the top of the ballot, so the base that was supporting them probably turned out in higher numbers than it might on January 5th. So, and I think Carmine takes the same position that is really not to be overlooked. That's not an unreasonable thing to understand. That is very much in play, and that would shift things to some extent. I mean, it would lead to a 50-50 Senate with the tie-breaking vote going to Kamala Harris as the vice president. So that's a possibility, even though it's probably likely that won't happen, and that there'll probably be 49 Democrats, and the Republicans will maintain control. So probably that's the election narrative, and I think that you can see in the market that the market's not really reacting to headlines about this process of litigating the voter fraud allegations because there really isn't a path where that process can lead to something that would change the ultimate outcome. It can delay some of the stuff that Biden is doing, and it can also impact some of the paths that he has ahead as that base consolidates. So it's not insignificant, but it doesn't change who's going to be president. And again, I think the market knows this, and that's why we're not seeing a lot of reaction there. Obviously, this narrative that we've had around the pandemic has been the most important factor in markets, and we just saw to start this week, new headlines on a vaccine that seems on its face, it hasn't been peer reviewed yet, but seems on its face to be a dramatically positive development in our understanding of where we're going to be, let's say, a year from now, where this virus is concerned. We're seeing another candidate come up too, which looks similar, is based on similar technology, and then we're also seeing a number of candidates for therapeutics. And Gavin and I talked about this on our last Sentiment and Flow show, that the therapeutics is really important because the degree to which the pandemic is actually impacting economic behavior has to do with people's perception of how devastating it would be to catch. So as we start to develop more treatments, people, it's possible, could, even as the case numbers rise, could even start to act in a little more normalized manner, simply because they're more likely to see hospitalization rather than as being a last-ditch effort, being something that can simply make them better. As long as we have the capacity available in the hospital system in the United States and around the world, then that's actually, the hospitalization factor becomes a different data point. And this is something I talked about, I think, last week. We look at hospitalization rate and we compare it to what we saw in March and April, but it's really apples to oranges, because in March and April, people were going to the hospital, but they did not think that the hospital had any way to treat them or cure them. It was simply a last-ditch effort because of how things were going. Now, people are proactively, young and healthy people with mild symptoms are going to the hospital because they know that there are things that people at the hospital can do to prevent it from becoming a severe case. So it's really apples to oranges when you start to compare the hospitalization stats. So if you take that out and you just look at death rate, the death rate's gone down dramatically as a percentage of cases in comparison, but the case numbers are gigantic right now, and it is scary. And there's these long hauler stories that you see, and certainly that's enough of a percentage that you still do not want to get this disease, and people are still probably going to be meaningfully impacted. And it's really spreading at this point to the point where it seems completely out of control. And again, I mentioned this the other day. In France, we're seeing a spread that looks like something that would be 3 times what we're seeing in the United States right now, given the per capita proportionality, given the populations of the two countries. So it's raging. It's absolutely raging in the Northern Hemisphere right now, and it's only November. And you can only imagine what it's going to be like in December and January. And that's a big factor, and probably one that's being underappreciated by the market. The last time we had a strategy meeting, I suggested that it is possible that we could see a sell the news reaction in response to meaningfully and substantial vaccine headlines that feel like we finally found the solution, it's on the way, that could lead to actually an intermediate term top in the market. So I'm watching the tape right now to understand that. One of the factors that I have been watching to start to gauge that is what we see in some additional asset classes. For instance, if you look at the U.S. 10-year rate, I think that if we were to start to see that roll over, I think that you would start to see a signal that the market would possibly follow. However, at this point, that has not happened. The U.S. equities market has rolled over more than the 10-year has off of yesterday's vaccine headlines. So actually, we're not seeing the signal from the bond market yet. Crude oil would be another market where I'd look for something similar. Crude oil, again, like the 10-year rate, is still breaking out. It looks like we're going to see new highs after yesterday's move.
Hey, Brett.
Yeah.
Before we move off the 10-year, I'd be curious as to your thoughts on this, because one of the things that I was thinking of that could have been impacting markets was a little bit of that pop in the 10-year, which I don't think a lot of people are prepared for yields to push higher. And, one of the areas that was getting hit particularly hard, obviously tech has been taken to the woodshed, but the home builders have too. So do you think, while we're not having runaway rates right now, that 16 basis point pop we've seen in the 10-year has kind of helped with the shakeout a little bit?
I think it's a rotation factor, right? So yeah, I agree with you 100% because the leadership shifts. But we saw the energy sector up 15% yesterday, and financials was up almost 10%. So you just see a different side of the market start to take leadership in a rising rate environment. That's in theory, that's cyclicality coming in as a strong factor. So we would just see different sides of the market start to take a leadership role. I wouldn't think that rates are anywhere near a point where we would start to see the level of interest rates become an impediment to growth. I think it would just favor different sectors. You've got, obviously, technology is the lowflation leader, no doubt about it, right? I mean, when you have really low and declining rates, when you have disinflation, when you have deflation, these are all things that basically mean investment needs to go into more efficient ways of doing things rather than doing more. And that's effectively the recipe for the mega cap dominance in the NASDAQ. When you go to a rising rate environment and a steepening yield curve, you get leadership from things like energies, materials, industrials, finance. And so we would see that, I think it's a reasonable case to be made that if we see rates continue to steepen, hold up, and we see this process of maybe we get fiscal stimulus and a vaccine, and we start to come around the bend, and we see a lot more cyclical strength. We've already put the genie out of the bottle as far as fiscal stimulus around the world. That's a new tool. So all of these things would suggest a steepening yield curve and that we maybe have seen a long-term bottom in long-term interest rates that could last possibly for a while. And this is something I talked about a couple of weeks ago because we were starting to see what you and I talked about as the sort of the risk parity ballast, starting to become dysfunctional. We would see stocks decline, but bonds decline at the same time. So that, I think, leads to that kind of framework as well.
All right, Brett. So, in terms of where you looked at, as far as you're putting together a thesis that you could be looking at a potential top in the market. Am I understanding that correctly?
So what I'm doing, and I'm not calling a top or not calling a top. I'm saying I'm really actively watching things every day with the idea that we're vulnerable to a possible sell the news. We've built into this point. Oftentimes when you get the crowning headline, you have the possibility of seeing people who have been hanging around in the market building up big portfolios with the idea of discounting that final turn in whatever narrative is driving the market. And when you get the big headline, people who've wanted to start to pull money out of the market, but were unwilling to, knowing that headline was coming, finally can start to pull money out of the market. It will be a test right now to see how much extra cash on the sidelines isn't involved in that kind of process and is ready to come in and buy every dip. I don't know what the answer is. It's one of the reasons why I said this morning I thought we'd shake out down into the 3,500 area, and I wanted to see what sort of tape we got. We couldn't even touch the level, and we got a big bid coming in at 3,510. Mm-hmm. So that works against the narrative of a big top. And again, it's only a few hours of market action, but watching that rinse and repeat, seeing those sorts of tests and seeing which way they tip will give me a sense of the balance of power, and then I'll be willing to start to have a larger time frame perspective. But I really don't have what I would consider to be a high conviction, larger time frame perspective on equities right now.
Okay. And also, let's not forget, I wonder if anybody has any perspective onto what we're seeing in the holiday season, because if things open up and there's prospects of stimulus, that would sound like the consumer would be in a really nice place, and that could project things higher. So just wanted to get people's thoughts on that as well.
In terms of what, Jim, just how?
In terms of the consumer having some money and the retail sector kind of leading the way, people feeling good, that should, in my mind, lead to gains in equities towards the end of the year. And then maybe we have another reset once we have inauguration, we have a settlement on, who's going to take control of the Senate come January.
Well, I guess the key for that is the question mark around stimulus. And, certainly the consumer has shown to be pretty strong the last couple of months, erasing one of the fears for the markets. It's one of the reasons why we've seen the markets perform so well despite this backdrop of a major pandemic and the uncertainty. We've continued to see money being put to work. Now, the question has always been, when that unemployment insurance pop from the fiscal side runs out, how does that impact consumer behavior? And it's obviously going to be one of the question marks coming up in the markets. And that's why I think, we're past the major part of earnings season, but we're coming in for what you're discussing here, Jim, for what could arguably be the most important aspect of this last 7 to 8 weeks, and that is when the retailers start reporting earnings. Just taking a quick look at this, Tuesday, November 17th, We get Kohl's coming out. Walmart's going to be out. That's obviously going to be a key read for the markets for their consumer. There's a name that I like coming out on Wednesday, and that's TJX, TJ Maxx. It's had a nice response here. Lowe's is going to be reporting that week. So we start breaking into all those names, and Macy's is another one. I think Home Depot might be that week too. But what we want to see is the consumer behavior continuing, and are we also seeing a transitioning on the consumer behavior? I think Beyond Meat is going to raise a red flag for some of these COVID winners like a Home Depot's or a Lowe's. Home Depot is the 17th as well, too, by the way. I just see that. We're going to see, was there that pull through in other areas that Beyond Meat saw that is just going to make for a rough 1 to 2 quarters, and certainly a difficult comps for a Home Depot or a Lowe's or whoever it might be going into the beginning of 2020. Now, obviously, department stores and people with less of an e-commerce footprint is going to see the exact opposite of that. But the upcoming earnings is going to be the telltale for how the market's going to treat the last couple of weeks based around the holiday season. Jim, would be my take.
All right. Well, outside of that, what are some of the other winners? Maybe Trend Tracker. Do you got any insight there?
In terms of like consumer?
Yeah, it's in terms of consumer, correct.
Well, as I mentioned this morning, and when I added to that position in purple PRPL this morning, we saw good results out of DR Horton, which is one of the largest home builders. So I do think the housing market's going to remain strong.
Even if we get a spike in rates?
Well, I mean, I guess that's like the Achilles heel if it's a really dramatic spike. It's already they're still historically very low. So I would think we need to see at least 1.5% on the 10-year, which would be a lot of times people say it's more about the speed of a move rather than the level. I mean, if rates go straight to 2%, then yes, housing is going to take a lick. But I would view that as the buying opportunity. These housing stocks are very cyclical, and they've been strong for a while now, like all year since the pandemic. So you kind of want to go against the grain, which is why I kind of have been more cautious on the home builders, and they've basically been flat for the last few months. So you kind of want to be going against the grain, so if rates surge and all these housing stocks went down, then I would view that as a buying opportunity, all else equal, because the housing market should have some legs given the supply deficit and the demographic tailwind.
Hey, Craig, real quick, because I'm eyeing up DHI as a buy here. I was watching that 66 level here. Would you be putting money to work yourself in DHI? I'm liking the way it's reacting right now.
I mean, I did like it this morning, and feel like I sort of missed it, but yeah, I mean, I do like it. They gave a very bullish view on next year, so the valuation is fairly reasonable, but at the same time, I suppose rates are the big risk. Because that will derail the whole housing trade, right? If rates continue to go in the direction they've been in the last few days, but I stay away from prognostications on rates.
Can I just interject something really quickly? I just want to point something out that's nothing to do with what you were saying, but it just happened. Fauci apparently is on TV, and he just said that he believes actually that the Pfizer vaccine that we heard about yesterday will start dosing for high-priority populations already in December, which I think is ahead of what we heard yesterday.
That's good news.
Yeah, that's certainly good news.
That's a nice Christmas present for the market, right?
Well, and there we have it. And that was one of the things that I was talking about just now as far as setting the consumer up, setting the last stage of the year here. I think it almost sets up for, we've had a tough year. 2020 be it the market, yeah, well, we're sitting here at all-time highs, but 2020 has been a tough year psychologically on everybody. Wouldn't it be something to have an upswing in the market and get everyone feeling good, and then we got our reset coming? And I don't mean reset as far as a fallout in the market. I'm talking about new variables in play. We've got a brand new world. We've got things starting up in 2020 that we haven't seen before, like a completely different mentality as far as it's almost as if the economy is reopening again. I know we've kind of used that word.
It's morning in America.
A little bit, a little bit. I mean, we have so many new dynamics that begin at the beginning of the year, and I think that the market's set up for a run up. I think people are going to be feeling good.
Hey, Brett, quick question for you, Brett, on the Fauci headline here. What was the other thing that needs to be cleared for this to get clearance? You had mentioned that peer review. How does that factor into anything here?
I don't know, but I assume Fauci knows. I mean, if he's on TV saying he expects it's going to go out, peer review should. I'm sure that he's seen the. I guess what I look at these sorts of headlines like, okay, he's gotten full access to the data set. He knows what to look for. He knows it's going to be fine. He said he expects the approval to go smoothly, no problem. So, in other words, the peer review, he would never risk his reputation after decades of being the top of his field saying something like that unless he knew. So I would say, the peer review is not going to be a hurdle, is what this says.
Yeah, so, I mean, they said they were going to apply for the EUA next week. So I don't know how quickly that turns around, a week or two or three. And it's all been produced ahead of time, right? They've been waiting for this.
I think they have 50 million doses lined up and making a lot every day.
Yeah. So, I mean, it's sort of ready to go. It's just gotta get through all the formalities. But going with your theme, Jim, I mean, the seasonality into year end is very strong right now, right? I mean, this is typically these last 6 or 7 weeks of the year are typically pretty bullish, right?
Yes, absolutely. And my premise is that, okay, we've already got that as a normal cyclical tailwind, but I just think that the way that things are shaping up right now, it could be even more of a boost. I think it's going to be very hard to fade this market. Maybe we'll have a little something going on in the next week or two. However, I think that it's going to be really tough to short this market towards the end of the year.
I generally agree, and like you said, we have the positive seasonality, and we have a whole new world to look forward to in 2021. So we've seen some pretty severe kind of rotations here this week, but really the only real concern, I suppose, is valuation. And if there's one thing that we've learned this year, is not to let valuation get in your way too much. We obviously have the Fed at our back, and we have stimulus to look forward to, coupled with this normalization that should happen next year. Obviously, tech stocks are, at least a lot of the software growth cohort is very expensive. But if you look at the industrials, they're also very expensive. The Honeywells and the large cap industrials have already done a good job of kind of pricing in this great environment that we should have in a recovery next year. So it's not like there's a lot of cheap equity out there. I mean, there are. It comes down to stock picking, but
maybe in the general, financials.
Right. Yeah. I mean, and I can, there's tech stocks that are relatively attractive, and but as a whole, the market doesn't look cheap, and I'm not sure it will, because we do, as bad as the economy kind of is right now, we have a lot to look forward to. So, yeah, I kind of let go of my valuation concerns in, I think it was May, and my performance improved a lot since that, after forgetting about all those valuation concerns, because you can look at a lot of stocks right now or even the whole market and just say, oh, it's expensive. Historically, it's expensive. So, you're afraid of that big correction. But yeah, I'm not sure it's coming. Like you said, it seems like a tough market to fade.
So I guess that's the cue for the technical analyst to come in
Yeah.
when you start dismissing fundamentals and valuations. All right.
Sure.
Yeah, so blue chip here. Anyway, no, great stuff, guys. I'm on board with pretty much everything you guys have been talking about here. And just to talk about the charts and whatnot, there's a couple of things that people should be a little bit aware of. And I think the key thing I want to focus on here, and just a quick segment here, is just the presidential cycle. So regardless of, politics, there is a presidential cycle, a 4-year presidential cycle that has been tracked, going back since the dawn of the stock market. And they just basically average out the gains of a 4-year term. And typically, the first year is a new year, and it's usually sees some pretty decent gains on average. It's really the midterm years, that the year 2 going into year 3, that tend to struggle the most and underperform in a very choppy sideways behavior. Towards the middle to end of year 3 into year 4, you get a much stronger rally. And the logic there is basically, well, it's actually it depends if whether the incumbent wins or whether a new party takes control. So usually when an incumbent wins, that everybody knows what to expect because they've already been used to the policies for 4 years. So usually the first year or that 5th year, if you want to call it that, is usually pretty strong when the incumbent wins because everyone, they can assess their risk. The uncertainty is not really there. They know what to expect. And then typically, after the first year gains of the incumbent, then things go into that second year slump sort of behavior. When a new party takes control, which is likely what's happening here, we basically see that first year, or I should say the first quarter of that first year of a new party taking control, it does tend to struggle. It's not necessarily a correction. It's not necessarily, failure to move higher. It just underperforms like around the average. And the reason being is because there is a changing of the guard. You have a whole new administration coming in, and you have all new policies talked about, and you have all these new changes developing. So the market just kind of tends to do nothing during that. I'd say it lasts about a quarter, maybe into the second quarter of the first year of each political party. Typically, you're waiting until the newly elected president chooses their cabinet, and then that usually happens sometime around March or April. And by the time that's all settled, then the market's able to basically assess their risk going forward, what to expect in policy changes and different agendas. And then the market tends to do pretty well, going into the summers of that first year of a newly elected political party. So just something to keep in mind there, if looking out over the course of the next couple months there. You also have to add in the fact, too, that we are at a 10-year cycle. Now, there is, if you go way back in the stock market, the years ending in 00, I think they're called the noughts, but basically they tend to be historically poor, in generally speaking. So you combine that, going into a year that's going to end in 01, those tend to be pretty choppy as well. They don't really see the market come rip-roaring out of those. So you have a little things going on here between a 10-year cycle in play, along with a new party change. There's a good chance that the market is going to be very choppy in the first portion of 2021. And, you can throw a bunch of other stuff on there, but this is all just cyclical, historical data. Of course, there's exceptions to the rules there. Like I said, anything could happen. We had a COVID crash. You had different things going on, different, agendas, anything could happen. But when you average it all out, these are basically the assumptions that are made going forward. So just some things to keep in mind there if you're just looking at the bigger picture. And that's the presidential cycle, really. So it's really kind of like just positioning yourself in the proper sectors, looking for those relative strength leaders and those relative weakness groups to avoid, and just kind of move forward there. So
Hey, Scott,
Yeah,
I got a
what's up?
question for you.
Yeah.
Are you aware of any kind of technical analysis, historical studies, and cycles that include whether or not the president has same party control of Congress or if they are
Yes.
proposed by Congress?
Yes, I have done recent research in that, and I did find some studies there. Um, Obviously, when they have control of Congress, it matches with the presidential party. The market tends to perform stronger. So,
Okay,
whether
gotcha.
it's whether it's been Democrat or Republican, I believe, if I recall, the Democrats have edged out a slightly higher gain on average, but it's minute. You're talking about like 0.6%. You know, it's not like it's going to be like a complete blowout, like a 5% greater gain or anything else like that. It's all within a 1% margin of error, depending on if the Congress and president line up. But generally speaking, when they line up, yes, the market tends to do better when they don't line up.
Okay, thanks. That makes sense.
Yeah.
All right, so why don't we talk about some other themes that are out there? I know scalp trader Damon, you've been involved in the REITs quite a bit. You actually took some profit in some of your names that you were holding. So I know that you now have a little bit more free powder or dry powder, if you will, and you must be looking at something. So what's up your sleeve?
Hey guys, yeah, I like energy here. I think with the economy reopening, oil could see a move higher. Energy names are still extremely depressed. They were hit hard in expectation of a Biden win, and it looks like he might put forth some policies that reduce production, such as not allowing drilling on federal land. So, that could actually have a positive impact on prices as well as the economy reopening in 2021. And if you look at the oil services group, for example, it's one of the few groups that's actually still down on the year. I think it's down about, actually I have it right here. Oil services still down 56% year to date. MLPs still down 43% year to date. The only other major group that's actually down on the year is banks, which are down 22% year to date. They had a really strong move yesterday and I think the end of last week. So we've had a big bounce in those. I think they were down at probably the start of last week, maybe down 40% or something year to date. So, I like to rotate into the value areas, the relative value areas. So energy is a space that I'm looking at right now. One of the positions we recently purchased was Laredo Petroleum, LPI, which is doing really well. Took some profits yesterday, and it's up about 35% from our entry. We bought some of their bonds, I think, last week, and those rallied 20% just yesterday. Bought the bonds at, I think, 52 cents on the dollar. They traded up to about 62 cents on the dollar, I think, yesterday. So, so I'm going to continue to look for those types of situations. I still really like REITs. A lot of the REITs were up 20 to 40% yesterday. It was just a massive move. And, this is something I probably talked about the past 3 or 4 strategy meetings, right? It's all just talking REITs, just given the attractive relative value. A lot of these names are trading at 50% of book value, and combination of low interest rate environment and attractive valuations. I just thought this space was going to be a home run type of group that both institutional and individual investors would come pouring into. In a low interest rate environment, people are going to be scrambling to find yield, and REITs offer that combination of price appreciation, capital appreciation, and the ability to collect double-digit dividends. So I thought that was a no-brainer. I still really like REITs, and I'll be looking to buy those names on pullbacks. But I think yesterday I probably had my second biggest day of the year, and it was just basically from REITs. I was very overloaded in REITs. I want to talk about that group. Seems like every day in my morning notes and strategy meetings, and finally paid off. We had just a really big move yesterday.
Another theme that you were talking a lot about was the SPAC space. It seems like that's lost a little bit of sizzle lately.
Yeah, the have kind of gone out of favor, which I really actually like. So I'm still keeping an eye on those names, right? So they've lost a lot of momentum. And so what you're seeing now is basically all of them are becoming busted deals, which is going to create an opportunity to sift through them and find the most compelling names. Like, for example, this is just a personal trade. I'm not ready to put it on as an official swing trade yet, but I bought some SFT just literally probably like 30 minutes ago, just to start to speculate in. This is baby like a smaller version of Carvana, and they just announced they expanded into Texas today. They've been in California. They've kind of basically looked at economies of scale and really focused on very specific markets versus taking kind of a national approach to things. So Texas is the next market they're moving into, which means growth should accelerate here over the next year or so. So I'm going to continue to keep an eye on these SPACs and just sift through them to find the most compelling opportunities. If you look at something like Lazy, for example, which is an RV play that I think we bought it maybe in the 8s or 9s. It went to 18 or 19 or so, but that could have been bought at 250 earlier in the year, and that was a SPAC, busted SPAC deal. I think you're going to see a lot of busted SPAC deals that we might be able to buy them in the 4s, 5s, 6s, and once you get a catalyst to kind of get them on the radar again and get some momentum going again, you might be able to make 100, 200, 300, 400% on your money. So those types of names I'll be researching, and I'll let you know if I come across anything compelling.
Hey, Damon.
Yeah.
This is Event Trader here. I got a question for you because, I know people just kind of group in the SPAC space altogether, and kind of compare it to IPOs and stuff. But I guess my question for you, if you have good answers, I don't see why the SPAC space would necessarily trade as as one single being. It seems like after it's rolled out, being an IPO or a SPAC or direct listing, whatever it might be, there's obviously some differences in the makeup of ownership of that stock, but the bottom line is that it should really just kind of come down to the merits of the company. Does it kind of have to do with the idea that maybe people think that the people who bought the SPACs didn't do the same due diligence as people that were rolling out IPOs? Because I guess I just don't understand why all of a sudden like SPACs would come in favor and go out of favor when once they're out in the public and they're trading and they have kind of a stock price value around it. It should be more based on the fundamentals. Do you understand what I'm saying and kind of what I'm asking here?
Yeah, definitely. And it's kind of like IPOs to some degree, right? When you get a lot of tech IPOs that the market's hot, and then you all of a sudden get 20 tech IPOs in 2 weeks or 3 weeks, and they're all popping initially, and then a lot of them eventually roll over. But I think with the SPACs, when you had DraftKings and what is the Virgin Atlantis or Atlantic, whatever it's called, and a couple other names that did really well, some of the electric vehicle names, you just had a lot of money piling into that space. And so anything that sounded somewhat attractive attracted money. And now, and the other thing is because basically you had the free look, so if you could buy something at 1050, but the actual cash value of the company is 10, and they'll give you your money back if you don't like the deal. People were just pouring money into these things, just hoping that the SPAC would make a purchase of an intriguing asset that would pop the price 50% or 100% in a day. That caused a situation where the SPACs were paying big premiums for companies and buying lower quality companies that were pre-revenue or very early in their revenue curve. So I just think you had just lower quality deals that were starting to come to the market and just too much money pouring in thinking it was a one-way trade. So I think you're starting to see some of that shake out a little bit. And just like with IPOs, I mean, I love when you get an overheated IPO market because then you get a big shakeout and you can start to sift through and find those next names that have the potential to go up hundreds of percent. You know, you could find the TTDs or the Canada Gooses or, you know, names like that that maybe come out in a heated market and don't necessarily do that well initially, but put together a couple of good quarters and then, you know, go on to the launching pad.
Yeah, no, that makes sense. Thanks.
Yeah, you're welcome.
Hey, I'm sorry, just to build on that too as an educational point, when a group does get really, really hot, and I've talked about this before, and the SPACs were a key example of this, August, September, the market starts to demand an ETF for it. And I've said this multiple times, and it's been proven over the last 20 years since ETFs have been rolled out. When they feel the need to create an ETF for a group that is just absolutely on fire and that it's complete euphoric, that is usually a telltale sign of a topping process being made. And SPAK is the ETF for that group there, and it came out in early October, and it pretty much just rolled over about 5 days after its debut. Now, it doesn't mean that they're all going to zero or anything else like that. It just points out the euphoric opportunity, cycle of that move is already basically you're in the final innings when that sort of mentality and that ETF makes its debut. Not to mention, I mean, I guess you can also say the reality is there's a lot of hedge funds and a lot of big portfolios who have been participating in those individual names on the run up. They're looking for ways to hedge. And one of the greatest ways for them to hedge is usually to start, diving into the ETFs on the short side. So that's just another thing to just kind of, brief little education piece there that I've been kind of pounding the table on the last 2 months to watch out for that SPAC debut. Kind of put a ceiling in on this space.
Is it out, Scott, or is it coming out?
No, it came out. It came out back in October. SPAK. Okay. Yeah, it pretty much went up for 3 days, and then it basically corrected about 18% thereafter. So, and if you're looking for any SPAC names like in the future, obviously this is a good tool as well, SPAK. You can always just do a search and look up the top holdings, and obviously that would give you a good little, starting point to go do some research on some individual names in the SPAK.
So speaking of SPAC, Damon, there's one listener out there who wants to know if you're still involved in FEAC.
I still have FEAC shares. Let me check to see if I still have them officially in the portfolio. Look, I know I still own them personally, but it looks like I was stopped out on the portfolio position on October 30th. When it broke the $11 stop, but I still own some personally. That makes a difference. I'm willing to, when I'm trading some of this stuff, I'm willing to take on a little bit more risk than I am on official positions. I probably have a tighter risk control on official positions. So if I say I'm still holding something personally, I don't mind riding something a little bit lower if I find it intriguing. So,
all right, and then one more thing for you, Damon. As we enter into 2020, we do have crypto markets on the move again. Are you going to dabble back in that?
Crypto is difficult to trade. I think once the algos came in, it just became really difficult to trade. I still have some Bitcoin exposure personally, just through GBTC, as well as there's a Bitcoin fund out of Europe that I still own. So I don't pay attention to it really. I just have kind of stashed it away as an inflation hedge, kind of crypto as a kind of a gold type play, a store of value. But I think it's really it's a very difficult space to trade, and I rather focus on equities.
All right. So I'm going to bring Trend Tracker back into the discussion here because you are our go-to technology guy, and that has been the weakness over the last couple of days, getting blasted. It looks like it may be, it has bounced off the lows a little bit today, but would love to get your prospects on the space in general.
Sure. Well, we've seen these pretty harsh um, shakeouts in the space. It's been on fire all year, right? And we've all been waiting, looking forward to the vaccine to kind of flip the switch there and get value back in vogue, and growth can fall by the wayside. But I we have seen these shakeouts. A lot of the stocks that are toward the top of that list I posted earlier, with the most expensive software stocks, are still, overheated. I still don't like paying 30, 40 times sales for a stock. So, we will see a key report this afternoon in Datadog. They report this afternoon. It's one of the most expensive software stocks on our radar here. And, estimates look like they're way too low, calling for some, pretty significant deceleration in their growth. So, we can assume that they're going to post another solid beat and raise. Last quarter, the stock got hit, I think, because it wasn't as big of a beat. It was a little bit disappointing. So, it'll come down to the reaction. So that'll be a key read. But I suppose my point is, there's a lot of people calling for this tech bubble to pop. I think it was David Einhorn last week at Greenlight who, said he was short a basket of the cloud bubble stocks. And while this rotation from growth to value would seem to be a great catalyst for that bubble to pop, sort of along the lines of what we were saying earlier, I'm not really expecting a crash or a true bubble pop, because we have seen these shakeouts before, and yes, I don't want to pay 50 times sales, so maybe we are due for some consolidation, but there still is value in the sector. If you look at something like Facebook, which is trading at like close to a market multiple, and that's a cyclical advertising stock. It isn't truly a COVID direct beneficiary. I mean, it's a digital ad stock, obviously, so it's digital, and digital transformation. Companies have been forced to maybe go advertise on Facebook when they weren't previously, but so either if it's Facebook or even Google that has exposure to travel. There's that Magnite, MGNI, which reported last night. Damon is in that as well. He sold, I think, last week. I sold yesterday just because the risk reward wasn't good. So I'm not really surprised to see the strong results get faded. But, it's trading at like 5 times sales. So there's definitely relative value, considering you got something like TTD trading at like 30 times sales. But the other one that I do like is Upwork, which had a big week last week on earnings, and you notice this thing is kind of just hanging around. It hasn't really pulled back significantly. When you compare it to, so this is basically a play on contract work, and that's an economic dynamic in this country that, yes, was brought on. It definitely accelerated by all the layoffs we have seen and all the remote work, but I don't think that's going away anytime soon. The cost of healthcare is another reason why this secular shift is likely to play out over the long term. You look at something like Fiverr, FVRR is the more successful peer, trading at like 30 times sales. So this one is still, they had that great quarter to really put them on the map, and yet it's still trading with like I think 7 or 8 times sales multiple. So it's really not an expensive stock. So we were kind of early on this one, but this is one where I can be good at identifying them early, but I feel like one of my weaknesses is not knowing when to buy on the pullbacks, because then that you can really compound the return. So this is one where I will try to, buy on pullbacks because it's still cheap. So, just because I liked it at 15 or 16 or whatever, a lot of times I get concerned about valuation. I've done it with a lot of my best investments, but this one still looks pretty cheap. So, it's not, the thesis is still there, and it's not expensive. So yes, tech stacks, software stacks may be due for some consolidation in general, and you just got to kind of pick your spots and try not to pay up too much. So yeah.
So is that your favorite name then? Upwork? UPWK is the ticker, right?
Correct. It's one of my favorites for sure, because it's reasonably valued. I think it's like a 2 point something billion market cap. So this is the kind of stock that, if all goes well, a few years down the road could be significantly higher, considering it's a $2 billion market cap, not trading at an egregious multiple of sales. Where we already have a peer that is kind of trading at a very aggressive multiple. So it's definitely one of my favorites.
All right. So, gentlemen, I got to talk about what some of the risks might be associated with the market. We've kind of outlined some good vibes that we could be seeing towards the end of the year, but we want to also make sure we handicap what the risks are out there. So feel free to jump right in and articulate any risks that you see.
As a venture here, I'll throw out a couple. Obviously, transition of power here is going to probably the biggest risk to the markets, I'm guessing. How smooth that could go, and does it impact fiscal stimulus talks? There's a lot of hope that even with a lame duck president, in terms of where it looks like we're headed, at least anyway, would we be able to get through any sort of deal? But I think President Trump has said that he would like to do a deal. McConnell has said that he would like to do a deal. It's just, I guess, a question of whether or not the Democrats would be willing to go along for something a little bit watered down. And but what that would do it would probably remove the other overhang that's kind of a derivative of this, and that would be, of course, the unemployment insurance and how that could impact not only the consumer but also payment back for credit cards and mortgages and stuff like that. So that's probably the biggest risk that I see to the markets. But naturally you got the COVID uptick, but I feel like we're just kind of at a place where we have a better way of running the economy around COVID, at least for now. All bets are off if we see hospitalizations and death rates just start spiraling out of control. But it feels like we've gotten a little bit better at navigating through some of the shutdowns. So I don't see that as big of a risk. But that the lack of fiscal stimulus and a sloppy transition of power, I would say.
Yeah, so let me follow that up. This is Chart Trader Brett, and I would agree with Gavin, and the way that I would frame it, which is really making the same case, is during a period where you have annualized job losses at 10 to 15 million, and you have a lot of pressures, and you're probably going to have a lot of people who are in a difficult situation. You're going to end up with most likely a lot of things being overly dependent upon government to act as a kind of ballast to support the economy. That's the counter-cyclicality that's always expected in a situation where the private sector has hurdles to overcome that cause things to misalign. And you end up with a supply-demand equation that has to heal. And really, in a lot of cases, it's a matter of timing, and filling in that gap is usually the responsibility of the federal government. And the fact that we're in that situation right now, and we really couldn't possibly be at a point of greater polarization, and we've got a divided government, and we have what could end up kind of feeling a little bit like a president and then also an alternate president in exile, trying to kind of have an influence on the situation at the same time. I think that how that all plays out probably poses the greatest risk, because I think the market, built into the pricing that we have right now and a lot of assets, the market assumes on some level that there will be additional major stimulus to come that's going to help fill the gap and bridge us over this process until we get to a point where private sector growth and the upward spin of the cycle can take over and make up for that ground and lead things higher. And that hole, there has to be a bridge over that hole. So I think if the process can coordinate itself so that we can have the federal government play its necessary countercyclical role at that kind of point of vulnerability, then I think the market's assuming at least like a 75% chance of something like that. If that ends up falling through, then I think that we'd have a significant problem.
And one other thing too that I'd throw in that I had mentioned before, and I think it's unlikely, but runaway rates, that is definitely something that, as we were talking about before, could trip things up.
Wouldn't the Fed be able to control that a bit, though?
I mean, they could do something like an Operation Twist and control one of the ends of the curve, but I think that the Fed, they got plenty of buying power left. That's for sure. They could always increase their current asset purchases from 120 billion to higher if that was to occur. I would not be counting on them given the amount of firepower that they've put out there. Not saying that they're out of bullets. We have seen commentary from Powell regarding that, but since then it seems like other members have walked it back. Lael Brainerd will be speaking later today, and she's going to be an important person to listen to because there's talk that she could be the next Treasury Secretary or even perhaps the next Fed chair under Biden. So, comments from her will be of note, but I think that the Fed might be a little bit more limited to what they could do. And if this was a spike up because the economy was getting better and all of a sudden we wrote a fiscal check that we don't necessarily need, I think it would be tough for the Fed to kind of put the genie back in the bottle and get those rates back down, because I don't know if they would have the buying capacity to really do it in a meaningful way if the rest of the globe was really just driving up rates here. So they would be able to limit the damage, but I think only to a certain extent. I don't know if Brett agrees or disagrees with that.
Well, the only thing that I would I don't know whether this is a disagreement or not, but I would say that rates to some extent are going to be chained to cyclical expectations. So it seems to me very unlikely you'd see a situation where you have rates running away at the long end of the curve into a massive shortfall in forward economic expectations due to a massive shortfall in stimulus or the ability of other sources to prop up the economy. So, I take what I'm seeing right now in rate markets to be kind of a little bit like, the market seeing around the corner in terms of reopening in concert with fiscal stimulus. But I get what you're saying about international fungibility, and I suppose that could be a factor.
And it would really come down to, Brett, as well, and we're always looking out, and it never seems to really come to fruition, the refinancing cycle. Where does that stand? Because then all of a sudden you're going to have companies with a lot of debt. I mean, a lot of them have done a good job at getting in at these cheap rates.
Yes.
But, if you're an airline and you're still in the midst of kind of borrowing as you try to get back on your feet and travel doesn't pick back up, even though the economy is, how does that borrowing process go out? But yeah, it wouldn't go lockstep if that's the reason why rates were going higher. But, it's something for us to watch and something that I think kind of rattled the markets a little bit this week.
All right, I want to open the floor and give anyone an opportunity for any parting shots if you have any. Now, there's one other thing that I forgot almost was at this time of year, we do get the potential for some tax loss selling that goes on, and I was wondering if anybody had any of those names on the radar.
I would think that would have to be the COVID plays. I know Damon and Scott are usually pretty good at the tax loss selling. I'd be curious if they had any thoughts. But, the CARES names I would think would probably be, especially if we saw COVID pick back up. I would think that they would be at most risk myself. And that tax loss selling should be starting right about now. So it would make sense that people would take advantage of this little pop in the markets to maybe sell off some.
Someone just to remind me too, or just confirm this, but if we're still waiting for the Senate, right, to go a certain way. So if Biden and the Senate are on the same side, will the tax rates increase significantly in 2021?
Capital gains would.
The capital gains tax would. Well, and when would we know that by? Like when was
January
that?
5th.
Like this, by when?
January 5th.
And they
Oh,
could
okay.
make it retroactive, I believe. Carmine would have to back me up on this. I think they can make it retroactive through January 1st.
Because if that becomes a real threat, I think you could see a heavy December tax selling by a lot of individuals. So, just something.
Well, we
to
won't
consider.
know. I
Like, why
think,
would you
before
want
the
to
end of
pay? Why would you
December.
want to pay at more than the 15% long-term capital gain? You know what I'm saying?
Yeah, no, I
Yeah,
completely
but
agree.
it'd be after the fact before you can do it. All right. As for tax loss selling, I mean, again, you got to look at some of the weakest groups that are out there. I mean, I could start off with marijuana stocks being underperformers for the last year until recently, but I don't think that anybody who's invested in that and a believer in that is going to be selling anytime soon. So I would say that group is off the table. As for energy stocks, if you've been picking these things up, for the last year or so or the last few months, thinking that they bottomed out here and they're going to do some sort of rise again, I don't think you're going to be. I think you're in it for the long haul, for the big turnarounds and whatnot. So, not to mention, I think every one of them continues to pay a really solid dividend yield. If you're looking for yield, the energy space is definitely an area to go. Even the XLE ETF, I believe, is paying around 5.5 or 6%. So you get the diversification, even in the ETF down there at those levels. So I just don't see that sort of aggressive tax selling going on. And it's tough to say, like, where is the tax selling going to come into play, because the market has gone up to fresh year-to-date highs lately. Perhaps it's actually in the high-flying technology stocks. With the potential vaccine, getting distributed in 2021 or as soon as December, whenever it happens, that whole work at home, study at home, stay at home sort of mentality shifts away a little bit, and you start to see a lot of profit taking in these overinflated, very expensive software technology names. That would be the only areas that I can really kind of come up with off the top of my head from a performance side of things of where tax selling may incur, but. That's a tricky bunch. That's always a real tricky area to kind of dive into and start making trades off of and taking advantage of, I think.
All right, then. Well, with that out of the way, are there any parting shots? Anything you want to leave the listeners with?
I would just add couple more things. I would pay attention to some of these Chinese ETFs, the KWEB. Again, I think with the Biden administration and maybe these tariffs get repealed back a little bit, you could potentially see some upside for the gains in some of those names. Although they have been performing really strong here, particularly the internet ones. We've talked about 5G multiple times, Gavin and I, on Trader Audio, just on months on end. Gav, if you want to just chime in there, but I know FIVG and NXTG are two ETFs that have to be tracked. They're doing really great these days.
Yes, I completely agree. As we've been hammering it. And, I was just going to throw in Broadcom AVGO as my 5G play. And as I had just posted before this call, I'm looking to add to Apple. I think both of them, if you look at the charts, are holding up pretty well considering some of the selling we've seen in the tech space.
Right. And then clean energy, a couple ETFs out there. So PBW is one that might be worth a look as well, if the policies are going to kind of go towards that area, PBW. And then, of course, I keep going back to the MJ, which is the marijuana play there. If you're really into the marijuana space, I personally think that it's just so new. relatively new, and it's kind of like this lottery ticket sort of investment to go after just one individual name. And if while I'm waiting around for any sort of regulations to get passed and whatnot, I would like to get paid a dividend. Plus, I like the diversity of an ETF. So I do think the MJ offers the best long-term investment, if that is, and it should be a little bit, it should be a little portion of your portfolio if you really think that the things are going to get passed, and that's part of the play there. I think that is one of the best ways to go is the MJ ETF. That's it.
All right. Anyone else? Going once. Going twice. All right. Well, I guess that will wrap up our strategy meeting for November. And I guess we will be back at it in December to recap some of the things that went on and give some more prospects for the up and coming year. But gentlemen, I want to thank you for joining us and thank the listeners for tuning in. We will have a recording, crossing our fingers that everything worked out well. Hope you guys enjoyed it. And again, want to thank you all for participating in this, guys.
All right, everybody, have a good one.
Yeah, thanks a lot, Jim.